Hey, what's happening YouTube? Hope you're doing well. Today is June 28th. Let's make a little Sunday video and we're going to talk about some very interesting things today. I'm going to talk about how implied volatility and the options market relates to the economic theory developed by Daniel Kahneman and his partner called prospect theory, and this other thing that they developed called the fourfold pattern, and how it links quite well. This is relating to human decision making. I'm sort of thinking about how these ideas relate to options trading and implied volatility. So let's get right into this today, guys. If you're interested in these topics, stick around for the video, leave a thumbs up, and let's get right to it here. So first of all, we need to understand what implied volatility is. Honestly, if you go on the internet and search up the definition, you're not going to find a very good definition. What implied volatility is a one standard deviation move in the underlying. In order to understand what that is, we need to know what a standard deviation is. We'll get to that, okay? A one standard deviation move up or down away from a mean, okay? So basically, implied volatility is calculated based on historical volatility to some extent, okay? So it uses data points and puts them together to calculate certain things. But keep in mind, there's other facts about implied volatility that are quite apparent, and we'll talk about them right now. So number one is regression to the mean. What is regression to the mean? This is a popular idea. It's simply the idea that when there is a recurring pattern, generally occurrences that tend to fall largely outside of the mean, for example, a drastic price move up or a drastic price move down, at the end of the day, these events will tend to revert back to what is considered to be the mean, or the majority of the time this tends to happen. Regression to the mean exists in nature, okay? Go read about it. The next thing is that implied volatility tends to be overstated. Now we need to explore why implied volatility is overstated. So I'm going to show you a chart right here, and you're going to look at this. This is implied volatility against 30-day historical volatility for the S&Ps over the last 3 years. Now the white line is implied volatility, and you can see that the majority of the time the white line is above the orange line. So that means that the majority of the time the market is implying a bigger move than it's actually getting. And the only time where historical volatility goes above implied volatility is when the market blindsidedly does something. And that is often what happens. Whenever the market has a somewhat of a black swan event, like what we happened in March, then implied volatility gets blindsided, but at the end of the day, it will always revert back to its mean. So whether implied volatility is being overstated or understated, at the end of the day, it's going to find a way to regress towards its mean. But now, what is the mean of volatility? Now, this is where prospect theory comes in, and we're going to explore what this is. Now, guys, I'm not an expert on any of this stuff, so if you don't understand what I'm talking about, it's all right, because I know that I might not be explaining it 100% correct. Basically, the reason why volatility is overstated is because a lot of the time people are willing to pay more for insurance than it's actually worth, and people are willing to pay more for lower probability bets to make a large amount. This contributes to the reason why implied volatility tends to be overstated on a consistent basis. Does that make sense? It's very clear here. The majority of the time the white line is over the orange line, meaning that implied volatility, the majority of the time based on this data, is in fact overstated. Until it gets blindsided, of course, like in this case right here. And there were some cases, like if you look at this, you can see that historical volatility stayed higher than implied volatility for 2 to 3 weeks. Historical volatility stayed higher than implied volatility. So you can see here at the highest point, the VIX was implying 3.5% moves, daily moves in the S&P 500, whereas some days we got as high as a 4% move in the S&P 500 daily, okay? And I'll just try and clear this up for you. So look at this option chain. So first of all, we have the VIX, which is the volatility index. What the calculation of the VIX is, a one standard deviation implied volatility for the S&P 500 being a 30-day look ahead. So which means that for the next 30 days, the S&P 500 is implying this amount of move per day, every single day. That's what implied volatility is telling you. Now, remember, implied volatility is a forecast. It's like a weather forecast, all right? The weather forecast says there's an 80% chance of rain tomorrow. There's a 20% chance of no rain tomorrow. But the thing is, we don't have data to prove that the weather forecast is overstated or understated. Implied volatility, usually overstated. We've established this, all right? So there's two ways you can view implied volatility. Number one is you can view it in an annualized percent, which is what the VIX is. The VIX is an annualized number. And then you can also view it in a daily number. So I have my option chain here set to see this as a daily implied volatility. So you see here 1.9%. That means that this market right here, this option contract right here, is implying a 1.9% daily move over the life of this option contract. The S&P's one standard deviation move is a 1.9% move. Now that brings us to what standard deviation is. You need to understand what standard deviation is for this to make any sense. The three inputs to calculate standard deviations is you need the data points, you need the number of data points, the values of the data points, and the mean, which is the average of all the data points. And once you can get all those things together, you can calculate where the majority of the occurrences tend to be. And that right there is standard deviation. So one standard deviation is expressed as 68.2% of all of the data points that you put into it, okay? So that means that 68% of the time, that is what a one standard deviation move is. 95% of the time, that is two standard deviations. So when I say the VIX implies a one standard deviation move, what this number is right here, this 1.9% IV, it means that for every single day that this market is trading, 68% of the time, it should move 1.9% every single day. Now, remember, that's the forecast. That's not reality. That's what the market is forecasting. The market is forecasting that every single day until this contract expires, the market is going to move 1.9%, 68% of the time. Do you guys get it? That's how we can begin to understand standard deviation and implied volatility. I know it's a bit complicated, guys, but go back, do your homework, and you can begin to understand this stuff. Okay, so we're gonna move on to the next part of the video here, which is I'm gonna be discussing prospect theory and the fourfold pattern and how this integrates into human rational decision making and how this affects how we make decisions on a regular basis, how the average person views risk, how we interpret risk relating to gains and losses in general. So prospect theory assumes that losses and gains are valued differently, and thus individuals make decisions based on perceived gains instead of perceived losses, also known as the loss aversion theory. The general concept is that if two choices are put before an individual, both equal, with one presented in terms of potential gains and the other presented in terms of potential losses, the former option will be chosen. What this means right here is that we respond worse to losses than we do to gains. All right, so think of this. You start from zero, and the thought of losing $100 versus the thought of winning $100, what's worse? Obviously, losing $100 is worse, which means that we respond worse to losses than we do to gains. And that's what prospect theory is explaining. Prospect theory was developed by Daniel Kahneman and his partner Amos. They actually won a Nobel Prize in economics for this. This is really something big here, okay? And that's why we need to understand this. I'm trying to put this together as to how this relates to options trading. So the next thing we're gonna move on to is the fourfold pattern. It's basically a graph about how prospect theory tends to work. Now, prospect theory is quite complicated, so I'm not going to be able to explain it in its entirety in this video, but basically it's a fact that we view losses as worse than gains, and that if we have the opportunity between a certain outcome and an uncertain outcome, a lot of the times when a loss is present, we will prefer to gamble, and when a gain is present, we will prefer to be risk averse. So again, it's understanding how we react in situations of being risk aversive and risk seeking. So this is what we're going to look at right here. So look at the fourfold pattern, and we have two events. We have a high probability event and a low probability event. And I'm going to explain to you how this relates to options trading in a little bit here. So the first one is a high probability of significant gains. We are more risk averse because we underweight the potential benefit. We have a fear of disappointment, taking favorable settlement. And the reason for this is simply because it's a high probability of significant gains, but there's still a potential chance that we can be disappointed. So our fear avoidance mechanisms are going to step in the way and say, if we have the choice between a high probability of significant gains and a 100% chance of a less of a gain, we're going to take the 100% chance of a less of a gain because there's still that fear of disappointment there. All right. High probability of significant losses. In this case, we tend to be more risk-seeking, underweigh the potential harm. Desperate to recoup losses, reject favorable settlement, continue gambling. And again, think about this. You're given the choice between a 100% chance to lose a lot of money and then a 90% chance to lose a little bit more money, but there's still a 10% chance that you can't lose any money. You would prefer to gamble in that case, even if the probabilities are still against you. That extra 10% chance that you could still get your money back, that's going to be what entices you to prefer to gamble than to prefer the certain outcome. All right, let's get to the low probability events here. So the low probability for significant gains, we tend to be risk seeking. We overweigh the potential benefit in hope for a large gain, rejecting favorable settlement, and to gamble. This is where your lotto ticket buyers are. This is where your call option YOLO buyers are. All right, because where you have a low probability to make a large amount, that seems enticing for the majority of us. Something in our DNA says that since the risk to reward is so good, we look for these 10 to 1, 20 to 1 risk to reward. In those cases, we prefer to gamble. All right, let's get to the next one here, which is the low probability to have a significant loss. In this case, we tend to be risk averse, aka we buy insurance. So we overweigh the potential harm, the fear of a large loss. We take unfavorable settlement. So this is where your insurance buyers are. For every statement that was written, I tried to write the opposite statement to kind of make myself understand it a little bit more. So basically, in a low probability to make a large gain, we have a hope of a large gain. There's that hope factor that plays in even though the probability is not there. In situations where we have a small chance to undertake a large loss, if we have the choice between a small chance to make a large loss and a certain chance to make a smaller loss, we're going to take the certain chance because we prefer certainty. So I hope you can understand by this fact that the majority of the time we're overstating the probability of certain things happening, and we prefer to gamble in the cases of low perceived risk, and we also prefer to gamble in the case of a loss that we can potentially reduce. Now, are you guys starting to see how this stuff plays into options trading? Okay, a lot of what I was just saying right now is exactly the kind of psychology that happens when traders are adding to their losers in hope that they can regain their losses, or buying certain bets in the hopes that they can generate large profits. This is also the reason why the majority of traders don't quite understand why options selling is a more logical strategy than options buying. Simply because the fear of a large loss overlooms the high probability of a small gain every single time. And again, that's the casino mentality right there. All right, let's see if I can conclude all of this information for you. Okay, so we started off talking about implied volatility and standard deviation. So we can understand that implied volatility is expressing 68% of likely occurrences over the life of whatever contract you're looking at. Again, you can view it in annualized terms or you can calculate it in daily terms. I prefer to view implied volatility in daily terms because I trade every day and I want to know what the prices of these options are implying because that can give you an indication. Remember, it's like a weather forecast. Implied volatility is the forecast of how much the market is implying that the underlying is going to move. So that's what implied volatility is. Remember, standard deviation is simply the data sets and where they fall into. So one standard deviation encompasses 68% of all of the occurrences of data points. And then away from that, we have two standard deviations, which should encompass 95% of all occurrences. What two standard deviation says is that 95% of the time, the price is going to stay between this point and this point. And it's very easy to see that in an options chain. Actually, if you have your option chain program like this, you'll see that right here, this is at the money, and this is down by one standard deviation, and then down by here is two standard deviations. So that means that 95% of the time, the price of this underlying is going to fall somewhere in between that price, 266, and all the way up here at to 50. And that's why standard deviation is important for understanding probabilities in the market. The next thing we need to remember is that implied volatility is, number one, mean reverting. When drastic moves happen, they tend to revert back to what is considered the mean. And then number two, volatility tends to usually be overstated. Now, why is volatility overstated? This relates to prospect theory. It's the fact that people are willing to pay more for insurance contracts, and they're willing to pay more for low probability bets to make large amounts. And that's why prospect theory relates to implied volatility and standard deviation. This fourfold pattern right here gives a great guide for understanding what could be considered the mean for human decision making, when we will generally prefer to be risk averse or risk seeking. All right, guys, so I hope you learned something from this video. I wish you all a fantastic day. All the best. Take care. Bye.